Global stock markets are currently experiencing renewed pressure. This situation is leading to widespread investor nervousness across various indices. The sentiment is primarily driven by concerns regarding artificial intelligence-related stocks. Specifically, there are growing anxieties over the valuation levels of these AI assets. Another key factor is a general shift towards a risk-off investment posture. This indicates investors are moving away from higher-risk assets to safer investments. The current market environment shows increased volatility indicators. This reflects heightened uncertainty among investors regarding market conditions. Market participants are becoming more cautious. This caution stems from concerns about future economic prospects and corporate earnings. Recent economic data significantly influences market sentiment. Geopolitical developments also play a crucial role in shaping market perceptions. These combined factors contribute to prevailing market anxiety among investors. Such anxiety can directly impact investor confidence in the market. Reduced confidence often leads to a decreased willingness to invest in riskier assets. Ultimately, these elements affect capital allocation strategies across various markets. U.S. stock futures are financial contracts that obligate a buyer or seller to transact a stock index at a future date. These futures, including the Dow Jones Industrial Average, reflect market sentiment before the trading day begins. Recent data indicates a downward movement in U.S. stock futures. This trend suggests a pre-market expectation of declining prices for the underlying stock index. Such movements are often interpreted as a signal of investor apprehension regarding future market performance. The Dow Jones Industrial Average is a stock market index that measures the stock performance of 30 large companies. S&P 500 futures are a key indicator reflecting the anticipated performance of the U.S. equity market. Recent data indicates that S&P 500 futures have registered decline. This downturn in futures contracts often signals broader market weakness. The weakness is observed across various sectors of the economy. The S&P 500 index serves as a benchmark for the overall health of the U.S. equity market. The NASDAQ 100 futures represent a key indicator for the technology sector. These futures are heavily weighted towards major technology stocks. Recent shifts in NASDAQ 100 futures have been particularly notable. This trend is closely linked to the increasing focus on AI-driven valuations. AI's influence is significantly impacting the perceived value of tech companies. These shifts reflect market sentiment regarding the future of artificial intelligence within the tech industry. U.S. futures movements are observed during pre-market trading hours. These movements provide an early indication of the potential market direction for the day. A negative trend in futures often suggests a lower open for the cash markets. Conversely, positive futures trends can indicate a higher opening for the day's trading. Recent market cycles have shown a significant increase in the valuation of AI-driven stocks. This trend highlights the prominent role of artificial intelligence in current economic landscapes. Companies recognized as leaders in AI technology have experienced substantial price appreciation. This appreciation reflects investor confidence in the growth potential of AI-focused enterprises. The valuation surge indicates a strong market response to advancements and applications in AI. Investors are currently scrutinizing the sustainability of elevated valuations in AI stocks. This examination often involves traditional financial metrics, such as price-to-earnings (P/E) ratios. For some AI companies, these P/E ratios appear significantly higher than historical averages. The high P/E ratios raise questions about future growth potential and investment risk. AI valuation often relies heavily on aggressive future earnings projections. These projections are tied to the anticipated widespread adoption of AI technologies. Current stock prices reflect these optimistic forecasts for AI-driven growth. If these earnings projections do not materialize as expected, market sentiment may shift. Consequently, current stock prices may be considered overvalued, leading to potential adjustments. Artificial intelligence, AI, promises transformative innovation across various industries. This innovation drives significant advancements and new capabilities in technology. However, translating AI innovation into consistent profitability remains a key challenge. Not all companies in the AI sector achieve large-scale financial returns from their innovations. This disparity between innovation potential and actual profitability creates a valuation gap. Consequently, concerns arise regarding the sustainable valuation of many AI-focused enterprises. Recent market gains are heavily concentrated in a few large technology companies. These companies are at the forefront of artificial intelligence development and adoption. This market concentration indicates a significant portion of AI valuation resides in limited entities. Such concentration can introduce systemic risk to the broader market. Setbacks faced by these dominant AI companies could trigger widespread economic instability. Current AI valuations are drawing comparisons to historical technology bubbles by some analysts. These past bubbles were characterized by intense investor euphoria. This euphoria often led to unsustainable price levels for tech assets. Such periods typically concluded with a market correction. The concern is whether AI valuations are following a similar pattern. Risk-off behavior describes a market sentiment where investors prioritize capital preservation over growth. It involves reducing exposure to assets perceived as higher risk, such as equities or emerging market bonds. Concurrently, investors seek refuge in safer investments, like government bonds, gold, or stable currencies. This shift is typically triggered by increased market uncertainty, geopolitical tensions, or economic fears. The objective of risk-off behavior is to protect portfolios from potential losses during volatile periods. During a risk-off period, investors become more cautious, seeking to protect capital rather than pursue growth. This behavior triggers a significant shift in investment patterns, known as capital rotation. Capital actively moves out of higher-risk assets, such as equities. This outflow is particularly pronounced from stocks with high growth expectations or speculative profiles. The rotation impacts overall market liquidity, as funds are withdrawn from these segments. Consequently, asset prices in the affected high-risk categories tend to decline due to reduced demand. During periods of market uncertainty, investors often exhibit risk-off behavior. This involves shifting investments from higher-risk assets to those perceived as safer. Safe haven assets are financial instruments expected to retain or increase value during market stress. Examples of safe haven assets include government bonds, known for their stability. Precious metals like gold are also considered safe havens due to their intrinsic value. Certain stable currencies, such as the US dollar or Swiss franc, also serve as safe havens. Investor sentiment surveys measure the collective mood and expectations of market participants. During risk-off phases, these surveys typically reveal a significant decline in investor confidence. This period is characterized by an increase in bearish outlooks among investors. Such a collective psychological shift directly influences broader market dynamics. It often leads to investors withdrawing from riskier assets and seeking safer investments. A risk-off mood in financial markets signifies a shift away from higher-risk investments. This behavior is often triggered by various economic uncertainty factors. Key contributors include rising inflation and interest rate hikes, impacting purchasing power and borrowing costs. Geopolitical tensions also play a significant role, creating instability and unpredictability. Concerns about a potential economic recession further amplify perceived investment risks, driving risk-off sentiment. Growth stocks are particularly vulnerable during periods of risk-off investor sentiment. These stocks often belong to nascent or rapidly evolving sectors, such as artificial intelligence. During risk-off phases, investors prioritize capital preservation over aggressive growth potential. This shift in investor focus leads to a disproportionate negative impact on growth-oriented equities. The short-term outlook for global equities is currently challenging. There is a potential for continued market volatility. Market participants should anticipate further price fluctuation. This indicates a period of uncertainty for global stock markets. Central bank interest rate policies are a critical factor influencing market direction. These policies directly impact economic activity and investment attractiveness. Higher interest rates can dampen overall economic activity. Elevated rates make equity investments less attractive to investors. Conversely, fixed income investments become more appealing in a high-rate environment. Upcoming corporate earnings reports are crucial for assessing economic health. Analysts will scrutinize these reports for indicators of economic resilience or weakness. Positive results could signal economic stability and growth. Conversely, disappointing earnings may intensify existing market pressures and volatility. Ongoing geopolitical developments are a significant factor in short-term economic outlooks. These events introduce unforeseen risks into global markets. Geopolitical shifts contribute to overall market instability. Such events frequently cause sudden changes in investor sentiment. They also lead to rapid fluctuations in capital flows across regions. The short-term market outlook presents a dynamic interplay between resilience and potential correction. Certain market segments are currently demonstrating notable resilience, maintaining stability. However, the broader market environment suggests a different trajectory for some areas. There is a potential for continued correction in segments identified as overvalued. This trend indicates a reevaluation of underlying market fundamentals by investors. Such reevaluation can lead to price adjustments in previously inflated assets. Global markets are currently navigating a complex period of economic reassessment. A key factor is the ongoing reevaluation of artificial intelligence, AI, valuations. This period is also characterized by a general shift towards increased risk aversion among investors. Investors should stay informed about these macroeconomic trends. Understanding these sectoral shifts is crucial for comprehending the evolving market landscape.